Good morning, everyone. This is Marshall Gittler bringing you the morning comment for June 27th. Yesterday's U.S. personal consumption expenditure deflator came as expected at 1.8% year-on-year, up from 1.6% previously. This indicator, the Fed's favorite measure of inflation, is getting close to the Fed's target of 2%. Now, Fed Chair Janet Yellen recently dismissed recent readings on inflation as noisy. Was yesterday's rise noise or was it signal? Richmond Fed President Lacker yesterday pushed back against Yellen, saying, "I don't think the last few months are entirely noise." St. Louis Fed President Bullard echoed that sentiment, saying that inflation is picking up now and adding, "I don't think financial markets have internalized how close we are to our ultimate goals, and I don't think the FOMC has internalized how close we are." That's pretty strong. Personally, I agree with Mr. Bullard. He said investors should be listening to the committee. They are not. The market's currently forecasting that the Fed funds rate will end 2015 around 0.68%, whereas the average forecast of the committee is almost double that at 1.2%. For end 2016, the market's forecasting 1.69%, while the FOMC is forecasting 2.53%. In other words, the FOMC is forecasting that hiking starts earlier and proceeds faster than the market currently assumes. I expect that the market will gradually start to discount at least the possibility of an earlier hike as inflation moves up and the unemployment rate falls. The question for the FX market, though, is whether that anticipation will be enough to counter the drop in real interest rates that's likely to occur as inflation moves up faster than nominal rates. Japan's usual end-of-the-month data dump produced a mixed picture for Japan. The inflation rate rose faster than expected as the effects of the hike in the consumption tax continue to work through the retail level. On the other hand, household spending collapsed in May, and base wages fell for the 23rd consecutive month. That shows the fatal flaw in the heart of Abenomics. The idea behind getting inflation up in Japan is to stimulate economic activity. But if the net result is simply to erode people's purchasing power, it will never work. Unfortunately, the hike in the consumption tax, which raised the CPI rate dramatically, has made further Bank of Japan loosening less likely in the near term. That could mean further strengthening of the yen. Indeed, dollar-yen finally broke out of its recent channel overnight on the downside. During the European day, the preliminary German CPI for June is expected to have risen 0.7% year-on-year. That's up slightly from 0.6% in May. An acceleration in German inflation would further reduce the already small likelihood that the ECB will unveil any new measures at next week's meeting, and could therefore help to shore up the euro. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.